Ever wondered why some people get rich while others struggle for years with little to show for it? It's not about luck, it's not about timing, it's about strategy. In this video, I'm revealing the 7 golden rules of investing that the wealthy follow religiously. And the best part, you don't need to be a financial expert to apply them. Whether you're just getting started or looking to level up your investing game, these rules can change your life. So grab a seat, take notes, and let's build your wealth step by step. Rule 1. Start investing early. Let time be your greatest ally. One of the most overlooked but incredibly powerful principles in investing is starting early. Time is the most valuable asset when it comes to building wealth through investments, primarily because of a phenomenon known as compound interest. Compounding allows your investment returns to earn their own returns, creating an exponential growth effect over time. It's the same reason why a snowball rolling down a hill gathers more snow and grows bigger the longer it rolls. Imagine 2 investors. One starts investing $200 per month at age 22 and continues until 40, while the other starts at 35 and invests the same amount until 65. Despite the second investor contributing for 30 years compared to just 18 years for the first, the early investor often ends up with more money by retirement because of the head start and compounding effect. Starting early gives your money the runway it needs to multiply many times over, and the earlier you begin, the less money you need to invest monthly to reach your financial goals. Even if you're not young anymore, the second best time to start is today. Don't fall into the trap of waiting for the right time or a perfect opportunity. Markets are unpredictable, and life will always throw curveballs. The key is to start with whatever amount you can afford and remain consistent. The sooner you start, the better your chances of achieving financial independence and enjoying a stress-free retirement. Rule 2. Invest consistently. Make it a non-negotiable habit. Consistency beats intensity. Many people believe that to get rich through investing, they need to make massive contributions or find the next big thing in the market. But in reality, the secret to building wealth lies in consistently investing smaller amounts over long periods. This disciplined habit is what fuels long-term growth and protects investors from market volatility and emotional decision-making. One effective strategy that embodies this rule is dollar cost averaging, DCA. DCA involves investing a fixed amount of money at regular intervals, e.g., monthly, regardless of whether the market is up or down. This approach ensures you buy more shares when prices are low and fewer shares when prices are high, effectively smoothing out the average cost over time. More importantly, it removes emotion and guesswork from the equation, 2 factors that often derail investors. Making investing a monthly habit is crucial. Treat it like a bill you must pay, just like rent, utilities, or your internet subscription. Automating your investments can also help you stay consistent. Set up automatic transfers to your investment account so that every paycheck contributes a portion to your financial future. Over the years, these consistent deposits grow into substantial wealth. The world's most successful investors didn't get there overnight. They got there by staying in the game and being consistent, even when times were tough. Rule 3. Diversify your portfolio. Don't put all your eggs in one basket. Diversification is a cornerstone of intelligent investing and one of the most reliable strategies to mitigate risk while maintaining healthy returns. Simply put, diversification means spreading your investments across a wide variety of assets and sectors to reduce the overall risk of loss. No matter how confident you are in a particular stock, sector, or trend, putting all your money into one place is dangerous. If that single investment fails, your entire financial plan could be derailed. Consider this. If you invest all your savings in one technology company and that company suffers a major setback or collapse, your investment could be wiped out. On the other hand, if your portfolio includes a mix of stocks, bonds, real estate, international assets, and even some commodities like gold or crypto, a loss in one area may be balanced by gains in another. This balance helps protect your wealth and creates more stable returns over time. Modern investment vehicles like index funds and ETFs, exchange-traded funds, make diversification easy and accessible. For example, investing in an S&P 500 index fund gives you exposure to 500 of the largest companies in the US across multiple industries. These types of investments help you build a solid foundation without requiring you to pick individual stocks or constantly monitor market movements. Diversifying not only reduces risk, but also enhances your ability to stay invested during turbulent times. It brings peace of mind knowing that your financial future doesn't depend on the success of a single company or industry. In short, diversification is your safety net, and every smart investor uses it. Rule 4. Think long-term. Stay the course. Ignore the noise. In the fast-paced world of today, everyone seems to be looking for quick wins and instant gratification. But when it comes to investing, adopting a long-term mindset is not just recommended, it's essential. The market goes through cycles, and volatility is a natural part of that process. Trying to predict short-term movements or time the market often leads to poor decisions driven by emotion rather than logic. Legendary investor Warren Buffett is a prime example of long-term thinking. He once said, "Our favorite holding period is forever." This doesn't mean you never sell, but rather that you choose investments based on their long-term potential, not short-term hype. If you invest in a well-run company or a diversified fund, the goal should be to hold on to it for years, allowing the compounding effect to work its magic. Market downturns, corrections, and crashes will happen. History shows that despite recessions, wars, and political instability, the stock market has always bounced back and continued to grow. Investors who panic and sell during downturns often lock in their losses, while those who stay invested typically recover and profit when markets rebound. Building wealth isn't about fast money. It's about patience and resilience. Stick to your investment strategy, review it periodically, and resist the urge to react to every market headline. Remember, investing is a marathon, not a sprint. Those who stay the course are the ones who finish strong. Rule 5. Educate yourself. Empower your mind. Protect your money. Knowledge is one of the most powerful tools you can possess as an investor. Unfortunately, many people hand over their money to investment platforms, advisors, or apps without truly understanding what they're investing in. This ignorance can lead to costly mistakes, missed opportunities, and even falling for scams. To get rich through investing, you must commit to continuous self-education. You don't need a finance degree to understand the basics. Start by learning about how the stock market works, what mutual funds and ETFs are, the difference between growth and value stocks, and how interest rates affect bond prices. There are countless free resources online, from blogs and podcasts to YouTube channels and courses. Over time, you can expand into more complex topics like portfolio construction, risk management, asset allocation, and tax optimization. Reading books is another great way to grow your financial knowledge. Classics like The Intelligent Investor by Benjamin Graham, The Little Book of Common Sense Investing by John Bogle, and Rich Dad Poor Dad by Robert Kiyosaki provide timeless lessons on investing, mindset, and financial literacy. When you understand what you're doing, you're less likely to panic during market swings, chase risky trends, or make emotional decisions. Financial education gives you the confidence to take control of your wealth and make decisions that align with your long-term goals. In the end, the best investment you can make is in yourself. Rule 6. Control your emotions. Don't let fear or greed guide you. Investing is not just about numbers, it's deeply emotional. Fear and greed are the two most powerful forces in the market, and they often lead to poor decisions. When markets are booming, greed tempts investors to buy into hype, over-leverage, or chase speculative trends. Conversely, when markets crash, fear takes over, causing investors to panic, sell at the worst possible time. To succeed in investing, you must learn to control your emotions and stick to your plan. Behavioral finance, a field that studies how psychology affects investment decisions, has shown that most retail investors underperform the market not because of bad investments, but because of bad behavior. They buy high and sell low, react to headlines, and abandon their strategies during market volatility. Overcoming these psychological pitfalls is crucial if you want to build wealth. Creating and sticking to an investment plan can help keep emotions in check. Your plan should include your goals, time horizon, risk tolerance, and asset allocation. Review it once or twice a year, not daily. Avoid checking your portfolio too frequently, as short-term fluctuations can cause unnecessary stress and impulsive decisions. Another great strategy is automating your investments, so you're not tempted to time the market. Automation helps you stay disciplined, consistent, and emotionally detached from daily market movements. The more you can remove emotion from the process, the more successful you'll be. Remember, in investing, discipline is more powerful than intelligence. Rule 7. Increase your income and reinvest everything you can. While saving and investing are critical, another powerful strategy to accelerate your path to wealth is to increase your income and reinvest as much as possible. Most people focus only on budgeting and cutting expenses, which has its limits, but your earning potential is unlimited. Whether it's through a side hustle, a promotion, freelancing, investing in skills, or starting a business, boosting your income expands your ability to invest more and build wealth faster. Once your income increases, resist the temptation to inflate your lifestyle. Instead of buying a new car or taking lavish vacations with your newfound earnings, channel that money into your investments. This creates a cycle of wealth, more income, more investing, more compounding, more freedom. The earlier you start this cycle, the faster you'll reach financial independence. Also, don't underestimate the power of reinvesting your dividends and profits. Many companies and funds pay out dividends. Shareholders share of the profits. Reinvesting those dividends instead of spending them adds fuel to the fire of compounding. It might seem small at first, but over 10, 20, or 30 years, it can dramatically boost your portfolio's value. Invest in yourself too. Take courses, get certifications, and develop high-income skills. The return on investment in education, especially skills that increase your earning potential, can be even greater than traditional market returns. When you grow your income and reinvest strategically, you fast-track your journey to wealth. If you follow these 7 rules, you're not just investing your money, you're building a future. Remember, wealth doesn't come overnight. It grows with patience, discipline, and smart decisions. If this video helped you out, give it a thumbs up, hit that subscribe button, and turn on notifications so you never miss powerful financial content like this. And let me know in the comments, which rule are you going to apply, starting today. Until next time, invest smart, stay consistent, and let your money work for you.